Well, with less than 15 minutes left until the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Some of the biggest moves in the market this week have been in the commodity space. Cocoa prices extending their record run, topping $8,000 per metric ton. And checking on the metals as well, copper hitting its highest level in nearly a year. And also, there's oil. Oh, let's mention that as well, because it's closing up more than 3% this week, despite edging a little bit lower today. Joining us now to break it all down, Blue Line Futures Chief Market Strategist Phil Streible and Path Trading Partners co-founder and Chief Market Strategist Bob Iaccino. Guys, it's great to see you. Thanks so much for being here.
Good to see you, Julie.
So obviously there's a lot of commodities out there. We've been seeing a lot of action. So if you're an investor and you want to get involved here, you know, it's kind of a tricky thing to try to figure out. Bob, I want to start with you. Is there anything that can be said about commodities sort of writ large, or do we really need to drill down and talk about each one individually?
Well, I think individual is valuable, and Phil's really good at that. But I just, on a broader sense, you are talking about something that is really a pure supply and demand story. And I think that escapes a lot of people. You're not going to have CEO scandals with commodities. You're not going to have missed earnings with commodities. You're talking about how much is out there, what does the supply picture look like, and what does the demand picture look like? And that's all it is. Now, while it can get complex with different sort of geopolitical volatilities, especially in the place of crude oil, we're talking about crude oil, that comes into play quite a bit. Inflation with gold, interest rates with some of the metals, including copper. The bigger picture is supply and demand. How much is there and who wants to buy it?
So, Phil, let's bring you in here, too, and dig deeper into a few different areas. Walk me through, Phil, I guess to start, how you're thinking about the energy complex, Phil, and oil in particular here. Highest level here since November. What's driving that, Phil, and what do you see ahead?
Yeah, so building on what Bob brought up, and it's a great point here, you look at crude oil, you look at the demand, and the resiliency of the U.S. economy has helped support the demand. We've got driving season right here, and any kind of interest rate cut could really be a tailwind for the crude oil market. If you get some of this loan, some of this debt burden behind us with lower interest rates, people are going to have more money to spend, and they're probably going to do it the easiest way, which is travel. So we're starting to see 2024 demand increasing, and we can see upward revisions in 2025 and 2026. You look at the supply side of things, we saw Ukrainian drone attacks on Russian refineries that could impact some of the Russian exports. We've also seen surprise drawdowns in EIA inventories of 1.5 million barrels this week, taking the yearly decline down to 33 million barrels. So you look at the bigger picture of things, like on the supply side, inventories are sitting at 446 million barrels versus the 5-year average of 528. So one other thing that Bob didn't bring up was price momentum. That also plays a big role, and you want to see those prices really moving in the direction that outlines and maps with the supply and demand picture, and crude oil prices look like they can go up to about $85 right now.
So, Bob, do you agree? I understand you're long oil, and I would ask where you're expecting it to go, and also how you think the best way is for people to play. I mean, you're a sophisticated investor in this stuff, right? So you're probably looking at crude oil futures, et cetera.
Yes.
For normal investors, should they be looking at ETFs? Should they go to the futures market? What's best?
Well, I always advise people that, you know, the thing that's 100% correlated to crude oil is crude oil. So the best place to play with that, or play that out, I should say, we don't play in investing, is WTI crude. That's my favorite. But for the average investor, you can look at USO. That's one of the ETFs people just generally default to. And for example, looking at SIBO Newsfeed, which is a new product from them, I'm seeing that USO is projected to be lower than their average daily volume, but the activity is on the call side of things. So to Phil's point about price momentum, and he's right, I did leave that out, and it's very important. My target on this was 82.50. Phil says 85, so I'm probably going to move it up to 85 now on the WTI. But the USO thing is very important, because your average investor is looking at that. When the activity is to the call side, that means the market makers are going to be slowly buying up USO if the volatility rises. One thing about crude oil, volatility in the equity markets, we generally associate that with a down move. Volatility in something like crude could go either way, and a spike in volatility, in which case the calls would be active then, could come on an up move, and generally it does, because we get a big supply disruption, like Phil mentioned, attacks on oil producers. That can cause supply disruptions and bring about volatility.
Phil, let's get you back in here. I want to switch gears here a bit, talk about gold, Phil, which has also been making a lot of headlines and for good reason. Strong run, Phil. It's near record highs. What do you think is driving that, Phil? And what do you see ahead? And how are you, if at all, playing that? Yeah, with the metal, the miners, both?
Yeah, when it talks to gold right now, I mean, we saw prices stall out right at about $2,200. We've come back from here. We're digesting, higher inflation data, also a very good economy right now. And those are things that prevent Fed Chairman Jerome Powell from cutting interest rates. And we've seen those interest rate expectations decline here recently. So I think that, gold needs a lot right now. It needs more clarity as far as the first interest rate cut. It needs to close over 2,200 to reignite the bulls. And it needs, Bitcoin to stop stealing the thunder of all the ETF inflows. So one thing to note on gold is that it's always the timing, the pace, and the depth of the interest rate cuts. And then finally, a study back from 1990 shows that after that first interest rate cut, after an upward cycle, gold has on average rallied 6% in the first 30 days. So keep that in your back pocket.
Yeah, are you willing to ride it there, Bob, as well, given some of those factors that Phil talked about?
Yes. So I had an interview at the end of 2022 where I called gold my most likely trade for 2023. I bought it in November of 2022. And I still have it, and I have physical, and I've been in and out of the futures contract from the long side. So the reason I like gold here is because a lot of things have to happen for gold to go lower in a meaningful way. And what I mean by that is the Fed actually has to pivot. People like to talk about gold as an inflation hedge. It's not if the Fed is active. Okay, because if the Fed is active against inflation, they're hiking rates, and that's negative gold. But if you have a Fed that is poised to be either neutral or dovish, this one I would argue is dovish, right? I don't think the Fed should cut rates, but I think they're going to. Gold will likely benefit from that, as Phil described. So if you get the Fed pivoting because inflation is reflating, which I think it's going to, then gold's going to be in a little bit of trouble. But I think we're going into a reflationary environment, meaning higher stocks, higher commodity prices, higher inflation, and higher gold. And the Fed is not likely to pivot to tighter monetary policy stance. So I like gold here as much as, not as much, but because it was cheaper in 2022, but I like it here for at least the first quarter of this year.
And Phil, we can't talk commodities here without getting your take on cocoa, Phil. This one has just been surging, hitting fresh records. Phil, what is driving that, and what do you see ahead? Any end in sight here?
I don't know. I mean, it's a pretty volatile contract. You had a 9% move today. That's a 700-point rally in cocoa. That's a $7,000 move. So again, from a risk management standpoint, you got to have a plan and what percentage of your capital are you going to have at risk. This cocoa story has been something that's been developing over the last few years, really since the Ukraine-Russia conflict, because a lot of the pesticides, a lot of the fertilizers came from Russia. The Ivory Coast was shut off. So that crop has been behind the eight ball for a few years now. Once you saw the news break that those forward contracts were being canceled, you had to know that companies like Nestle and other, cocoa utilizers are going to be scrambling to get any kind of near-term supply. There was something a little bit off on the price action yesterday where you looked at the deferred contracts, they all closed lower. So the squeeze is really on the first 4 months out here. But that's a contract, Bob's probably got a better way to play on that with some ETF or something, because there's not a mini, there's not a micro contract. What percentage of your capital you want to be at risk? You might want to just let this one go and just, stock up on some Cadbury eggs for Easter or something.
Stocking up on Cadbury eggs. Never a bad recommendation, Phil. Phil, Bob, thank you guys both for joining the show today. Have a great weekend.
You as well. Thank you.